Hello, friends. Welcome to this special episode. Today, we will talk about should you invest in falling markets. So, now the markets have been falling, and a lot of folks are worried. Of course, yes, most of the folks are worried. Uh, the question that we are frequently facing is that should we invest or should we wait? Should we wait for the markets to go up to start investing? Should we wait for the markets to bottom somewhere before we start investing? Is it a good time to start investing? These are, the common relevant queries that we get almost on a daily basis. So we thought we'll do some data analysis and showcase what happens when you start to invest at various stages of the market. So if you remember, we had done some studies earlier when we showcased what happens if you started investing from the peak of the markets. So today what we're doing is we are studying what happens when you start investing from drawdowns. So let's say this entire part one of this series will be about Nifty, and then in the part two, a few days later, we will talk about our own products, how they have fared if somebody started at a 10% drawdown, 20% drawdown, 30% drawdown, so on and so forth. So, in the last 23 odd years, on your screen, you can see this many occasions have come where the Nifty has been more than 10% down from the peak, starting from 2000 and up till very recently. So these are the use cases that we want to see. What happens when you start investing on a top 10% drawdown, and then we will go forward and see what happens when we start investing from further deeper drawdowns. So most of these cases are very sort of common in the sense this was a dot-com bust. Then in Jan 04 you had the oh, sorry 04 you had the election correction. Then in 2008, you of course you had the great financial crisis, global financial crisis in terms of the Lehman crisis coming later in 2008, then demonetization, small cap fall in 2018, COVID fall in 20. So many of these were related to specific historical events in the market, and these were the Nifty levels at each of these occasions. The CAGR from these points, so from March 2000 till today, would have been 10.92% on Nifty. From January 2004 till today would have been 12.5%. So if we see, on a CAGR basis, you would have had, a double-digit return in most cases, or near double-digit return, if you even started, at the near the top of the market. But at 10% drawdown, you are very very much near the top of the market, and that study should essentially tell you what happens even if you don't start at the top, but if you're waiting for some time and you are at 10% drawdown, what happens then? So the XIRR that we've calculated, so your first SIP is going in at March 2000, next is going at April 2000, May 2000, and you're sipping on a monthly basis till today. So in the last so many years, if you continued your Nifty SIP, today you would be sitting with the XIRR of 12.47%. Similarly, if you started in Jan 4, if you did a SIP every month, you would be sitting with the XIRR of 11.08%, and so on and so forth. So essentially, you can see that in the entire range, of course, December 2021, because the period is so short, we can sort of maybe take only 3 years or more as a standardized benchmark. But you can see one very unique feature here, that from every 10% minus drawdown that you started with, the end result was between 10% and 12% odd on the Nifty. So regardless of which year you started, where you started in terms of the timing. But if you were 10% below the top, you ended between 10 and 12% on the XRR, which is very close to the long term CAGR on Nifty. So if we see another use case, let's say we were to wait for a 20% drawdown and we don't want to invest, but we say that unless there's a market drawdown of 20%, only then we will start investing. Some people are wanting to time the market better, that we don't want to invest in a market which has not fallen yet. Fine. So, I mean, these were the use cases. About six or seven use cases came in the last 20 odd years, where the Nifty actually was down 20% from its recent high. And when we invested based on these investments, you can see that the CAGR from April 2000, again 11.5%, from May 2004, 13.4%, 10.95, 11%, 13%, 20.83% from COVID lows. We can also consider this to be a very exceptional data point. But other than that, the CAGR remained between 9% and 13%. And the XIRR, so on starting from these dates, remained between 10.3% and 12.5%. So very, very similar to what we saw, in terms of the previous case of 10% drawdowns. Is even if you waited for longer and you only got seven opportunities in the last 23 years. So if you missed, for instance, 2008 opportunity, then the next opportunity for you came only 3 years later. Or if you missed August 11, the next opportunity came only 5 years later. And I mean, you cannot really keep waiting for the market to start your entry. So again, what we can see is that the XRR remains in the range that what we have seen. Now, third case, somebody says that I will only start investing once we have at least 30% drawdowns in Nifty. So only three cases have come around in the last 23 years. In March 2000, in terms of uh, the dot com bust and global financial crisis in 2008, and COVID. So very, very exceptional years of having 30% or more drawdowns. And if we waited and started from here, the CAGR would have been 12.2% from 2000, 9.68% from 2008, and of course COVID, as I mentioned earlier, exceptional returns from 26%. But XIRR on these starting points from 2000 May, 12.4%, from June 2008, 10.8%, and March 2020, 12.5%. So again, even if you waited for those market timing points to start with, you end up with the similar XIRR of 12% odd. So what does this study tell you? Even if you waited for 10% drawdown, if you waited for 20% drawdown, if you waited for 30% drawdown to start your journey, the end result is pretty much the same if you held on for a longer period of time. So what is the sort of insight that we can draw from this? First and foremost, India is a growth market. The market has bounced back every single time that we've been in a drawdown. That is the first and foremost, insight that you need to draw from this long-term study, that the markets always bounce back. Now, there of course will be stocks, there will be sectors which will not bounce back. There will be sectors which will not do well for decades or years at least. There will be sectors which will underperform. There will be stocks that will get extinguished, that will get merged, that will get bought out, that will get totally destroyed. So what you need to do is to have a strategy which is self-repairing, self-healing strategy. And Nifty is of course one of such instruments, where the Nifty never goes down when you look at it in perpetuity, and because it gets replaced, the weaker stocks get replaced by stronger stocks every 6 months. So Nifty is a self-healing instrument. So it continues to go up. Of course, it has its dips as we've seen, but eventually the stronger stocks take it up. And that is the beauty of investing in the index, and of course doing SIP in the index, so that you can get all the benefits of the SIPs as and when the dips come. But of course the underlying is continuously rising. So India is rising, the GDP is rising, the index of Indian markets continues to rise, and then there are strategies which can beat these index, and you can do even better than the index. So there are several avenues of these investments that are available to you. The next insight that we want to draw from here is that investing during a drawdown increases the chance of extracting better returns. So while it is, if you were to look at it from a lump sum basis, that the market fell down 30% and you invested a lump sum there and you waited for the next 10 years, of course your CAGR returns on that will be much better than whatever data we have presented. But the data that is showing is that regardless of 10%, 20%, 30%, or even from the top of the market, if you have started to invest and you're gradually bringing in your capital, your end result, your XIR result does not really change much. Uh, it is also proven that SIPs emerge triumphant even if you start at drawdowns, as you may be compensated whenever there is another correction. So even if you're starting at a drawdown and your market starts to go up and now your SIP is coming at higher and higher levels, but the subsequent fall that the market sees, there you will get the advantage of bringing in your capital gradually, and so on and so forth. So market will move in its wave like fashion, and the SIP mode will ensure that you are able to make use of those ups and the downs in the market to get more quantum for your each installment that you're putting in. So as I mentioned earlier also, we did a study starting from the very top of the market. So what happens if you start from 2000, top of 2000, top of 2008, or top of 2018? Again, there is hardly any deviation from the results that we have seen here. Again, on Nifty you will find XRR of nearly just about 12% odd, in regardless of where you're starting from. So this timing of trying to time the market to start your journey is in my view futile. So it's a pointless wait if you're waiting to start your journey. I mean, in my view, the best day to start was yesterday, and the next best is today. So if you are on the sideline, you are waiting, you're thinking, I would recommend that you stop thinking and start your investment journey, because this is not a short term journey in any case. I mean, you have to be looking at 3, 5, 7 years as at a minimum to make sure that you catch at least one large market cycle in that period. I mean, there can be lucky phases where you start off and you get a huge run up, like a lot of people did in 2020, but that will not happen every year or every few years. So you need to be invested, you need to start, you need to keep investing, and then once in a while you will get that huge run that we witnessed in many times in the last 6 7 years since Weekend Investing is offering these products. So the idea is to remain invested, the idea is to remain vigilant, the idea is to remain consistent with your SIPs and allow the market to do what it does best in the long term. So, with this, I'll come to an end to this special episode. Thank you so much for watching. And please do share these videos with your friends and family if you like them. And we'll see you in another one. Bye.